JJ the CPA here. Hope you're doing well. So for those of you that are going to apply or reapply for the PPP as a Schedule C filer based on your gross income, let's explain what line 7 is. I'm going to go ahead and share my screen here. Just want to let you know the best source of information on any of this, if you have questions, the best thing to do is to put your reading skills to work and go to sba.gov/PPP, and you can see that they have this all laid out for you by sections, first draw, second draw. Now, these applications mirror themselves as it relates to the Schedule C filer that's now applying based on the gross income. There is a difference between first draw and second draw application in that the second draw application requires that you have a reduction in gross receipts by at least 25% in any quarter in 2020 compared to the correlating quarter in 2019, or you have an overall decrease in gross receipts for 2020 as compared to 2019. But when we then look at the application, part of what we see here, and I really do appreciate the SBA making this super clear and crystal clear, is that it indicates that you're putting the gross income, Schedule C, line 7. So it's listed there several times, line 7. So you probably already would guess that you would just go to Schedule C and pick line 7, and you wouldn't be wrong. So on your Schedule C up here, you have 19, we have 20. The great thing is on the application, you get to choose here if you're using 19 or 20 because you get to use the higher of. That's the same as if you're reapplying or applying. Now, when you are looking at the Schedule C, you'll note here that gross receipts less returns and allowances minus cost of goods sold is then the gross profit, and then other income items here that would come into play. This other income would not be unemployment income, it would not be PPP, it would not be the EIDL grant. This other income would be typically very rare to have any amount in there for a Schedule C filer, because Schedule C filer really should just have gross receipts. But nonetheless, it is based on the gross income, which is after the cost of goods sold. So the gross income, line 7, you take it for either one and you plug it in and then follow the math. You'll see here, of course, that they've got a section here if you don't have employees, and then a section here if you do have employees. So when you're looking at your line 7, the reason that I'm glad you stayed till here is that you probably want to evaluate what you're putting in cost of goods sold if you have cost of goods sold. Because when you're then looking at cost of goods sold, it indicates here that you come from line 42. I'll tell you this, the SBA has already ruled on this over on the EIDL side, is that if you're in a service business, you don't have cost of goods sold. Cost of goods sold is that you are selling goods, okay? But you would want to look carefully at your inventory and what purchases have been allocated there, what labor is being put there, what materials and supplies, and what other costs, your ending inventory. And the reason I say that is that there could be somebody who's helping you prepare the return, and based on how you're keeping your books, or based on how you're wanting to present things to a bank or whatever the case is, you may be putting things in cost of goods sold for purposes that are not then required to be there for IRS purposes. So don't hear me as you doing anything differently than what you've always done. But cost of goods sold has very specific instructions to it. It has very specific items that go to it. You might feel that something is a cost of goods sold. And just an example of this is that my clients that are dentists. Now, I don't have one dentist that's filing a Schedule C. All my dentists that are clients file an S Corp. But nonetheless, on their financial statements internally from QuickBooks, we include in cost of goods sold only for management purposes what they pay their hygienist, what they pay for dental supplies, what they pay in credit card fees, and what they pay in lab fees. And the reason for that is that with my clients, I'm helping them do an analysis to go, okay, you did collect this, but these are the expenses in cost of goods sold. That's just what it's called in QuickBooks. There's no way to change that title. But with my clients, I'm including it in a category predetermined only by QuickBooks to be then labeled as cost of goods sold, so that my clients can see, well, here's what you collected. Here's the direct expenses to you generating that income, for then the client and I to analyze the gross profit. Gross profit being on QuickBooks, here's your gross receipts minus what we decided were the direct expenses to that gross income. But in a dental practice, okay, those cost of goods sold items, they're providing a service, are not what I indicated. Okay, now if they're selling dentures, or if they're selling a product, right, there is certain things a dentist could sell that is a product, then yeah, there might be some actual IRS defined cost of goods sold that we would be putting in cost of goods sold. But on the tax return, I don't list any of those items in cost of goods sold. Now, for an S corporation, it makes no difference. An S corporation isn't applying for a loan based on any of that. They're not being able to apply for a PPP loan. So I'm not indicating to you anything other than here's an example in a different kind of business, but similar to how things are being reported on Schedule C, that there very much could be a difference in how you're setting up your books or your QuickBooks. And it very well could be that who has been helping you to prepare your return is just taking the information from your QuickBooks, from your internal financial statements, as you will, and putting it on Schedule C. Because guess what? In any other manner, it doesn't really matter in terms of your bottom line, meaning when we're looking at your line 31 here, for tax purposes, it's all a deduction anyways. And quite frankly, with those that are Schedule Cs, you're not even required to have inventory allocated at the beginning and the end because you're too small of a business. You can if you'd like. Point is this. I want you to be mindful that if you're finding that your gross income is being reduced by cost of goods sold and you're a service business, then you need to rethink how you're reporting this, not only for this purpose, but for IRS purposes, because whatever you report to the IRS has to be what you're reporting to the SBA. Now, I want to make sure everybody's hearing me clearly, okay? Because if you don't know me, okay, I'm a CPA, I'm a certified public accountant, and I am not at all trying to show you how to manipulate a number. I'm not trying to be cute with you. I'm not trying to be smirky. And I would ask you not to manipulate your numbers. What I'm indicating to you is that in very technical times like this, you need to understand what it is that you're putting on your Schedule C and what impact it has on your PPP to ensure that you're doing everything perfect, that you're doing everything correct. So it's me saying to you, you don't have someone preparing your return that's an idiot and inept if they have been putting things in cost of goods sold because you've been putting things in cost of goods sold because in QuickBooks you put things labeled as cost of goods sold for your own management purposes. It is not uncommon that the way that you reflect things on your financial statements as a small business, because I don't know of any Schedule C that has audited, reviewed, or compilated financial statements. And if you do, great. You're even proving my point more that this is a tax return and you reflect things on a tax return according to IRS rules. So hear me as follow the IRS rules. Make sure that you're following the rules. And to look at this another way, if you do have cost of goods sold and you're not putting it as cost of goods sold, then you need to now put it as cost of goods sold. Meaning, maybe you've been keeping your books to where you don't have anything listed in cost of goods sold. And on your tax return, you on your Schedule C have never listed anything in cost of goods sold. Well, you probably need to make sure that there's not something in your expenses that is cost of goods sold. Well, what's cost of goods sold? The goods. The goods that you have bought to resell. Yes, it does include labor. What labor? The labor that if you bought a good and converted it, built it, improved it, the labor directly to do that would be part of your cost of goods sold. So the entire video is to encourage you to make sure you understand what it is that you're putting on that Schedule C to ensure that you're doing it properly, that everything is allocated here properly. And then you let the chips fall where they may. I'm not talking about, oh, well, let's back some stuff off of cost of goods sold that should be in there because it helps me with the PPP. The entire point of this video is to say, make sure that from now on, that your Schedule C, as it relates to cost of goods sold, is including what is defined as cost of goods sold, which is just what I told you. So again, if you don't have cost of goods sold and you should have cost of goods sold and you just haven't ever reported that way, then guess what? You need to now report it that way. You now need to make sure that you are taking into account that your gross receipts need to be reduced down by your cost of goods sold to arrive at a proper amount for your gross income. And the same is in the reverse. If you're including things in cost of goods sold that are not really cost of goods sold, IRS determined, then clean it up that it's only including the amount. So that if you're looking at this, you're just simply doing it properly. And if you go, well, here's my gross receipts, here's my cost of goods sold under what the IRS is indicating, SBA indicating cost of goods sold, then there's your gross income. There's your line 7. And then you let the chips fall where they may. Don't manipulate the numbers. The point is, make sure your numbers are correct, that you're properly reporting this on a tax return that has nothing to do with your QuickBooks, has nothing really to do with, quite frankly, your opinion. And if you're dealing with somebody that's saying, they'll never know, you don't need to put in cost of goods sold. Well, don't let that person ever prepare anything for you ever again. All right, hey, hopefully that helps explaining gross income, explaining line 7. I am going to have another video, though, that is going to talk about when you're then going to do your second draw PPP application and you have to have your gross receipts down by at least 25%. That is based on a different number, okay? It's based on gross receipts. This right here, line 7, is gross income. When you're looking at your 25% dip, it's based on gross receipts, and it's right there in the instructions where you'll be able to see that. So look for the other video on that if you're looking at the second draw and looking at the qualifier. So gross income is different than gross receipts. All right, hey, thanks for tuning in. I'd love it if you'd subscribe, and then don't you ever forget, you've never met a CPA quite like me. Have a great one.